Well, hello there. Welcome to BST Live, the show for systematic and algorithmic traders. Glad you could join us today. We're going to be talking about low effort trading strategies. And our guest is Cesar Alvarez from Alvarez Quant Trading. Welcome, Cesar. Thanks for joining us today. Well, we're having an audio issue. I can't hear you. I can't hear you, Cesar. Let me just check what's going on here.
See, testing 1, 2, 3.
There we go. I can hear you now. Can you hear me?
Oh, yes, I can hear you now.
Okay, excellent. I don't know if that intro came through or not. So welcome, Cesar. Glad you could join us today. We're going to be talking about low effort trading strategies, right?
Right. Thank you for having me. And I'm glad I could be here today. And it's always fun to talk about these kind of topics.
Exactly. So I just want to start by saying a big thank you to you because we did have another guest booked for today and something came up and that guest had to postpone. So you're here on very late notice. And so I really appreciate you taking the time to join us today. It's great to it's great to see you here. So thank you.
Yes, it's my pleasure. I'm glad I could help out and manage to squeeze this into my schedule. And I'm always willing to help you out.
Excellent. Thank you. So as I mentioned, we're going to be talking about low effort trading strategies. And before we get to that, though, can you give us a quick little background on yourself for any of the new listeners that are joining us today?
Sure. I've been a systematic trader since about 2001 and used to work for Larry Connors for about 8 years. Of tradingmarkets.com. And about 8 years ago, I decided to go out on my own and I started Alvarez Quant Trading, which is a blog where I publish about once a month articles on systematic trading geared for the intermediate to beginner trader mostly, but there are advanced topics there. And more recently, I've started Tranquility Trading, which is part of my private trading club where it's more advanced topics for traders there. But I love talking about trading and helping beginners get going in this great field and very challenging area.
Yeah, excellent. All right. So you have been on the show a number of times before, so people have seen your face and heard a lot of your work through your website as well. Now, low effort trading strategies sounds like a good thing, and we're going to explain why. I came up with that title actually, but we're going to be talking about rotational trading. Now, how about we start with the very basics first before we dig into it a little deeper? So can you explain a little bit about rotational trading, what it is, and why it's, I guess, a low effort trading style?
Right. So rotational trading typically means only trading once a week or looking for setups once a week or once a month are the most common timeframes for this. So, let's say every weekend you would go through your strategy, see what signals were coming in and decide what you were going to buy Monday morning and what you were going to sell Monday morning. These are very nice because, like I said, you only have to worry about them once a week or maybe once a month, depending on your strategy. I actually have a strategy which I do once a quarter. Wow. They are, I like them personally. I think I'm trading 3 rotational strategies right now. So it is definitely not one of those things that's only for, some people think, oh, they're just for beginners. No. I think as you get older, like I am, you tend to get a little bit lazier and like these less, like you said, these easier trading strategies that you don't have to be worried about every single day looking at the markets. So that is the quick review of what a rotational strategy is.
Yeah. So what was it initially that drew you to that particular style? Was it basically just the frequency was lower, or are there other things there that are advantages in what you were looking for?
Right. One of them, of course, is just the less effort that's required for them. But another thing is how do I put this? They get a little bit different luck in a sense, because sometimes you'll notice when you're trading, you'll get in out of a stock and it'll continue to go up after you get out, or you'll get in at the wrong time. And by waiting, just trading once a week, this luck kind of sort of changes in some respects, sometimes for the better, sometimes for the worse. But I find it's a good balance with a typical strategy, which is trading daily. I just find that it complements a daily strategies quite well.
Okay. I'd like to come back to that luck statement you made a little bit later, but first we've got a few other things which we can talk about. Now, you mentioned that the frequency of the trading is weekly, monthly. You even said you had one that was quarterly. What is the difference between obviously the frequency, but what is the difference between those particular frequencies? Like, is one better than the other, or
no, none of them is better than the other. I mean, part of it
right?
is, I say, time diversification. So, I don't know if readers or listeners have heard of this. People heard diversifying strategies like, having mean reversion strategy, a trend following strategy, maybe a breakout strategy. But another way to diversify is through time. So, how you have daily strategies are trading, trading daily, ones that are trading weekly, and ones that are trading monthly potentially. So that is why, that's kind of why I kind of like focusing on different ones. It gives me a little bit of time diversification there. Especially when you're doing something on a weekly or monthly basis, you could then tend to use weekly or even monthly charts instead of doing daily charts. So that also gives you another time diversification that you can use there.
Yeah, I think it's a general human tendency, though, to think more is better. Have you have you found that? What about daily rebalancing type of thing? Is that worse or better, or what's your research found there?
I've not done too much research on daily rebalancing, mostly because at that point, to me, that is very high frequency trading when you get to something like a rotational strategy. So that'll get you into positions a lot quicker. And I tend to not like anything else, because once you get to be trading that quickly, things like execution costs, your commissions become very critical. And I don't like that being critical part of my, having to depend on getting perfect execution or, making sure I have perfectly low commissions and things like that. It's funny you mentioned that, because I just had a client of mine coming to me that we started weekly. He was saying, hey, should we go to daily? And I had to talk him out of, no, you don't want to go down that path, just because your commissions will start to kill you really quickly on something like that.
Yeah, right. That's an important consideration to have, I guess. But, what about things like universe selection, though? Are there particular markets that are good for this style of trading, or ones that you should avoid? Or what kind of universe do you select for this rotational strategies?
Right. That's a good question. I've actually been surprised. Originally I thought this kind of universe selection, when I first started these, were better built for like S&P 500 stocks, NASDAQ 100 stocks, or for the bigger cap stocks. But eventually I actually started trying low cap stocks and found out that it actually works quite well down with the lower cap stocks, with the, those kind of stocks. There are some negatives to that, though, which we'll talk about a little bit later, about some of the negatives of rotational trading. And they become a little bit more amplified as you get away from those bigger cap stocks. But I have found, like I said, I have a strategy that is trading what I'd call not even Russell 3000 stocks. They are stocks that are newly trading. They've been trading only 2 or 3 years. That's all they have is a trading history as my rotational strategy, and it works quite well.
Yeah. Well, since you brought up the negatives of rotational trading, maybe now's a good time to do that, because I can think of a few that you just kind of alluded to then. Do you want to give us some more details about the negatives of some of this rotational trading strategies?
The biggest negative of rotational trading that tends to happen is, let's say you're doing weekly and some news comes out on Tuesday, the stock gets craters because it's, they say, hey, we're going to miss earnings, and it just starts to sink. And then you just watch it sinking 3-4 days before that week, that day, that Friday comes that tells you, okay, yes, you're going to get out of this. You're going to get out on Monday. So that tends to be the biggest negative, is when these negative events, or when the market starts to crash. And if you've got something like a market regime filter in, having to wait till the weekend to get out, just because the market happened to crash on Monday or Tuesday, it's like, great, now I'm here sitting and waiting for that to happen. So that is actually what I'd say more of a psychological negative, because often these things will bounce, and they may bounce by the time that weekend comes around, or that rotational period comes around. That they may bounce. That happens much more in the weekly. The monthly, I think, in order to work around that negative, at least for my own strategies, I tend to have, even though I may get into a position on a monthly basis, I may check it on a weekly basis whether I should be getting out of it, like whether the market regime filters change, or whether it's hit some sort of stop loss target that I have. So that's one way, in a sense, I try to get around that, because waiting a month for a stock that's suddenly cratering is a long time to be waiting for something.
Yeah. Yeah. So what about then, like if you're doing, say, a weekly rebalancing, what about what day of the week is better? Because I can imagine that there may be some differences between doing it on a Monday and on a Friday. And also, like if you're doing monthly, what week are you looking at? The first week? What have you found with the actual start date?
Right. So yeah, it's really funny that you mentioned that, because I am right in the middle of working on some research that is testing the what day of the week the rotation on a particular strategy. I did some research on this. Oh my God, 20 years ago on what day of the week. And of course, there's, just because of randomness, one day of the week is going to work out better than the other. I mean, it doesn't matter. Every day of the week is not going to have the exact same results. One of them is going to be better. My biggest thing is, when you look at that, you don't want to see a huge variation, on that. That would get me a little bit worried if I was working on a strategy and for some reason Tuesday's results were significantly better. That would probably scream to, or point me towards, okay, maybe there was some sort of market timing regime filter that happened to get you out at the right time or something like that. But, I tend to favor for the weekly rotation strategies. I favor just, getting in and out on Monday morning on that, so my signal day is Friday. I have the weekend to process the signals and figure out what to get out on Monday. I've not seen enough difference there to make, for me is to say, okay, one's better than the other. Now on the monthly time frame, I actually avoid trading on the last day of the month. So most monthly rotational strategies will say, okay, the last day of the month is when I get my signal. And now the first day of the next month is the day I will enter and exit my trades. I have tend to found that tends to be a really bad day overall. So I tend to usually pick something like the last Friday of the month or the first Friday of the month or something like that instead to do my monthly rotation. Now, that will sometimes mean that there'll be 5 weeks in my month, a little bit longer than normal. But I find for some reason, there are so many other people doing monthly rotations that I tend to see more negative or more weird stuff happening on that first day of the month when I'm trying to get in and out of position. So I've purposely avoided that day now for years. And try to, like I said, my main thing is maybe, the last Friday or first Friday kind of thing like that.
Yeah, I guess as well, when you're looking at things like day of the week, those can drift over time, right? So it might be Monday is good for a few years and then suddenly it's a Wednesday. So I think that goes to your point there saying, it could be purely random.
Right. Yeah. And there could be a reason why, I could probably make a reasoning why maybe Friday might be good or or Monday might be good or Monday might be bad. But again, it's never consistent, especially like you said, when you break it down on a per year basis, you'll definitely see some years it's better to be Monday for 2 years in a row. Also, it's Wednesday, and it's just kind of random. If you start chasing that, you're just going to get bad results. So for me, especially for the weekly rotation, it's like just pick a day. So Andrew Cleanow put out a book where he was rotating on Wednesday. He just mentions, well, I just wanted to pick I had to pick a day, so I picked Wednesday. Not as good as reason as any other. So I've never tested his thing to see, what would have been better to do on Monday. Who knows? But again, I think it's more important to be consistent and not get caught up of, last year I would have done so much better had I traded on Thursdays. Okay, this year I'm trading on Thursdays. You're just chasing performance. And that, as much as I know the desire to do that, it can be really frustrating. But you're just going down a path of bad news if you go down that way.
Yeah. Now I want to ask you about ranking metrics. But before that, excuse me, you mentioned a couple of times market regimes. So before we get to all the ranking metrics, I want to ask you, are you looking at rotational only from a long side? Does it work in short as well? Or do you do a mix? What do you do for the different market environments there?
So for the market environment, long, yes, it works. And I use a market regime filter on most of my strategies on the rotational side. So that's good. So I'll just pick a very simple common market regime filter, the 200-day MA. I have not found a rotational strategy that works on the short side. And quite honestly, my short strategies stopped working several years ago. And a couple months ago, I was trying to see if I could revive them. Something's changed about short strategies. I don't know if, I'm sure other people are having success with those, but my strategies have all died and I cannot seem to get them working again. Back testing, trying to figure out what's changed in the market for the last couple of years. They're always been hard, and I'd be very leery of any short strategy also on a rotational, just because you really, when things start going against you, you need to get out of short. A short gaps up 50%, and trust me, you trade shorts, it's going to happen eventually. You need to get out of those. You need to figure out when you're going to get out really quick on those, and waiting even a couple of days could be disastrous. I mean, imagine being short GameStop on some sort of rotational strategy. Your account would just, your account would just blow up really quickly.
Yeah. Okay. I guess maybe that, looking at what's been happening in the markets, maybe your short strategies will come back in sometime soon. We'll have to see what happens.
Yeah, I've been waiting for that, but I don't know what's happened to my short strategies. I want to say about 3 years ago, they just started to fall apart and just have not done well at all. Even through last year's early sell-off, they did not perform as well as I would have expected. I mean, thankfully I haven't been trading it, but I can't imagine doing a short rotational strategy. I'm sure people out there have them, but I have not done anything that I've liked on that side.
Okay, so when you're looking at this is kind of back to the universe selection, but when you're looking at how many I guess instruments or stocks to include in your rotational strategies, what kind of number are you looking at, and what impact does that have on the overall results?
So are you talking the size of the universe, or how many positions I can have at one time?
Sorry, how many positions do you take? Do you take 4 stocks or 8 stocks, or what's the number for you?
That one is very variable in the sense of I got one strategy that I'm only doing 5 on, and I think another strategy that I'm doing about 12, if I remember correctly. A lot of it becomes it's a position sizing thing, in the sense of my higher risk strategy where I'm trading smaller stocks. I don't want to be in a big position, so that's why that strategy is trading 12. So that's how I'm managing the risk, in a sense. Or one part of how I'm managing risk is by having smaller position sizing there. I've got another strategy where I'm trading NASDAQ 100 stocks. They can be volatile, but nowhere near as volatile as a stock that's only been trading for 2 or 3 years. So for that one, I'm only trading 5 positions. Yep. In general, what happens is the less positions you trade, the better your returns, but the higher your drawdowns. So it's one of those, you kind of want to get less and less and less, but then it becomes, okay, how much volatility are you willing to get? There is a point though, in my opinion, somewhere around 5, 4, especially 3, where luck starts to play a really huge role on your, because at 3, it's one of those, you get the right one or the wrong run, that will have a huge impact on your return. So, I definitely, for most people recommend 5 is about as small as you want to go. Maybe 4, 4 or 5 is like you're on that edge of really playing around with how lucky you're getting with the selections.
Right. Yeah. Okay. So I want to ask you about ranking metrics now. How do you actually determine, or what? How do you determine which stocks you want to put into that portfolio? I know you've done some recent research actually on your blog, and you published it on alvarezquanttrading.com, so people can go back and have a look at that. But can you talk a little bit more about what your research into ranking metrics has found and what you like to personally use?
Right. So I've done several pieces on ranking. Quite surprising. Using just returns, it turns out to be a really good ranking method. It could be as simple as saying, hey, I'm going to rank by the 3-month returns, or even the slightly more complicated, saying I'm going to take the 3-month returns, add the 6-month returns, add the 50% of the 12-month returns, and then rank by the highest that way. That has just using some sort of recent returns, whether it's 3 months to somewhere. I find the sweet spot between 3 months and 9 months tends to be a good length of time to be looking at. And also combining combining a shorter one with a longer one also tends to work really well. That's been my preference lately. Another very simple, stupid one, which when I tested it, I couldn't believe it worked so well, but it's one of those, I still can't make myself trade it. It's just breaking by the highest price. I've got a blog article that just basically says, I think it's on the SP 500. It's a blog article. It's just buy, part of it was just buy the highest priced ones. There was a couple other little factors like, it's an uptrend about the 200-day moving average. When it finally came down to ranking, it was just, highest priced one, buy it. I think a lot of that is probably coming because stocks don't do stock splits as much anymore as they used to do. I mean, when I started trading 20 years ago, stock splits happened all the time, and now it seems to be a rarity. I think companies, these successful companies like seeing their prices go up in these big numbers, and I think that's why now the price is working so well as a momentum, kind of as a momentum filter. Because that, at the end of the day, is what you're looking for. Is you're looking for some sort of price momentum, and rate of change, how something's done over the last 3, 6, 9 months is a great filter. And this also gets a little bit, on the ranking, gets to a second thing. Ranking gets you, often on rotational, you'll say, okay, I want to buy the top 10 ranked stocks. And then a week later, I want to see which ones are the top 10 at that point and buy those 10. I tend to like to give the ranking a little bit of breathing room. So I'll often say, for example, I'll say, okay, buy the top 10 stocks, but only sell when it falls out of the top 15. So this way, if I buy the stock that's ranked number 10, just because it falls down to rank number 11, I don't need to sell it. This kind of reduces the churn that you can have in a strategy. And I find something like that tends to work quite well versus just saying, okay, I'm always in the top 10 kind of thing like that. Does that make sense to you, Andrew?
Yeah, absolutely. Yeah. I know as well that you're a mean reversion guy. And, one of the challenges sometimes with ranking stocks in momentum is that they've had a big run up and then they'll just sit there for a while and go nowhere, but they're still being ranked really high on a momentum basis. So is the technique you just used there where you're looking at it from different time frames, is that to address that issue, or how did you come up with that?
It's more that, I'm looking for something that's had good momentum in multiple time frames or multiple lengths of time. I don't want something that's just had a really short run up, or like you said, or partially like you say, it's had the 6-month return has been really good, but the 1-month return has been really flat. So, that would get you out of those kind of, keep you out of those stocks that have suddenly flattened out. Yes, it can be, as my original trading, as you said, tend to be focused on mean reversion. That's what I'm known as, which is quite unfortunate in some respects now, because I trade now breakout strategies, momentum strategies. I'm all over the board now, what type of strategies I trade. And it is hard for me sometimes to look at those charts, those momentum charts, and going, oh crap, why am I buying this? It's had this huge straight up, and my mean reversion roots are screaming, no, you don't want to buy this. It's going to pull back. So sometimes it's like close my eyes, press just enter, place my orders in interactive brokers, and hope for the best kind of thing. But on these momentums, on these type of momentum things, you will be buying some of these things that are gone straight up like this, and that's what you want. That's what you want on these kind of things. I've tried to do kind of like a mean reversion rotational strategy, and I've not had any really good success with a mean reversion rotational strategy. I would imagine that have to be kind of on a weekly basis kind of thing. I guess if you're really crazy, you could try it on a daily basis. But again, I don't like those. That just turns the account over too much for my liking.
Okay. Now, something you just mentioned a little bit earlier was stock splits, and also index constituents like S&P 500 obviously has changed over time. So you've got the survivorship bias effect in backtesting. How do you address some of those issues to make sure that your backtesting is actually, realistic? Right.
I mean, data is the lifeblood of a quant trader, and making sure you have good data is the most important thing. I mean, so, I have data. My data provider gives me, historical constituent data. So I can go back on any day in the last 30 years and say, tell me exactly what stocks were in the S&P 500. They also handle all, stock splits and things like that. So, that finding a data provider that does that for you is really, really important. That will, if you don't do that, I've actually written blog posts, I believe, on, saying, hey, here's what happens when you don't have this kind of data, and it can really skew what you think is correct. So, making sure you've got the right data. now you may be doing a rotational strategy on, let's say, the spider sector ETFs. So, that there is no stock splits, there is no real survivorship bias, though they've added some things and slightly changed it over the years, but that's basically stayed pretty constant. So if you were doing a rotational strategy based on that, then you wouldn't have to be worried about it. Or they say a rotational strategy based on a small basket of ETFs that has existed for, the last 10, 20 years, kind of thing like that.
Yeah. Okay. Now, we've got quite a few questions in the chat, which I want to get to in a moment. But first, I'd like to ask you about your exits and your risk management. Now, you did mention that you like to give it a little bit of room. But can you explain a little bit more about your approach to exits and how you manage the risk in those positions?
Yeah. So I manage the risk in two ways. So I know a lot of people like, using ATR or, I'm only risking 1%. I have found from my own personal trading and my, and my testing that kind of risk management doesn't give me that much extra boost. So I tend to keep it simple and say, okay, I'm only investing 5%, 10%, into each position. So the way like I alluded to earlier, the way I do partial risk management is if I got a strategy that's trading lots of really volatile stocks, then I'll trade maybe only 5% per position. But if I'm trading a strategy, like if I'm trading the NASDAQ 100, which, I'm not likely going to be opening up down 50%, then I may do 20% per position. So that's one way I manage the risk. A second way is I do have stops. All my rotational strategies do have stops of when to get out. Now, the stops my stops are what I call end of day stops. So they are stops that are evaluated at the end of each trading day, and then we decide whether they're going to get out the next day. So even my weekly strategy may get out on Wednesday if the stock really, goes down quite a bit. It is not an intraday stop. I find intraday stops get hit quite a bit and bounce back up, for at least my own personal stuff. So this adds a little bit more work. So it's, in a sense, it's a rotational getting in and a daily getting out. But it's so little work to say, hey, did it hit my stop? No, okay, I'm fine. So I don't see it that it adds that much extra work, but gives me a little bit better, risk management by knowing I have a stop, in place for the position.
Okay. There's a question in the chat here that segues nicely into what you're saying there. I'll just put it up on the screen. This one's from Ola. Thanks for the question, Ola. Would you say it's worth rebalancing position sizes during a trade?
Good question. Something we should have brought up. The way, so second thing I do is I don't rebalance during the trade, but what I do is I have profit targets. So I usually will have some sort of profit target, and when that profit target is hit, I will then exit the position. So what can happen is kind of like a rebalance. Is let's say on Friday I hit the profit target, so I'm scheduled to exit it on Monday. But then when I re-rank, I find out it's still highly ranked. So therefore, I get back in. So now I've taken it. So in a sense, I've rebalanced it. But that's how so I wait till it gets pretty big. I think rebalancing is good because if you don't rebalance at some point, then what happens is your strategy becomes can become dependent on when you started trading your strategy, how that will have a great impact on your results. So, because if you don't imagine if you took a strategy that was trading Tesla and you never rebalanced it, it would just become so huge in your portfolio that it's just trading Tesla, and that's just not what we want.
Yeah. There's a question here from Ed. Let me put this one up on the screen. G'day, Ed. Do you ever override your trades, and if so, on what basis?
Actually, the funny part is rotational strategies, I override a lot less. The only thing I would say I slightly override is the situation I just gave you. So when I've hit a profit target and then I'm scheduled to get right back into it, I may make a decision to say, okay, now I'm not going to rebalance it too small. I'll just keep the bigger position size because it's not that big. So I would call that more of a partial override. But in general, I tend to be close my eyes, push the buttons. Half the time, I don't even know what stocks I'm in. I've got a trading friend that'll sometimes call me up. We're often trading the same things. He'll go, oh my God, did you see what XYZ did today? I go, no, let me first see if I'm in XYZ before I start to panic. And it's like, oh yeah, I'm in XYZ. Okay, what happened to it today? Am I happy or sad now? So, I tend to be, through years of doing this, I've gotten to the point where I'm just pushing the button. For a while, I just had a little post-it on my computer that just said push the button. Overriding tends, you really, really want to minimize how often you override your strategies.
Yeah. Okay, thanks for that, Cesar. Now we've got a couple of questions on ranking, so let's go into that a little bit more. So let me see which one. Let's have this question from Simba. G'day, Simba. Here we go. Coming up on the screen. Do you apply a recent trend following filter to filter out high momentum stock that is selling off in the short term?
Not specifically, if I'm, let's say, am I doing, depends on what you mean by short term. If you're talking like the last week or so, then the answer to that is no. Usually when I'm ranking, I'll rank by something like the smallest ranking period will usually will be about a month. So that won't often be enough to catch a recent, depending on how, if it had a really good run up and then it's had a pullback, it might not be enough to make it not rank. So normally I'm not looking for those, those stocks that have sold off, in the last week or so. If there's been a sell-off in the last month, then my ranking will usually catch that because that's about the small time period that I'm using.
Yeah. Yep. Okay. A question here. Another question from Ola, actually. Let's put this one up on the screen. I know you're going to like this one.
Hi, Ola. How you doing?
Do you filter for Do you filter for volatility of individual stocks?
Yeah. Well, I guess the question. So I can take that question one of two ways. Whether I want high volatility stocks or don't want high volatility stocks. And the answer is yes, and it depends on the strategy. There are times where I say, you know what, I want the high volatility stocks. And there are times where I say, no, I don't want the high volatility stocks. So that volatility tends to be a really good filter and actually a good ranking method too. So part of it is, if I want more return, that you want the high volatility stocks. If I'm trying to dampen the drawdowns, that I want to avoid some of the really high volatility stocks. By high volatility, especially if I'm trying to dampen the drawdowns, it's like HV100 historical volatility, 100-day historical volatility over 80 or 100. Because those tend to be really crazy moving stocks at that point, and they can move really quickly both up and down. So that tends to be where I cut off if I'm trying to reduce volatility.
Yeah. Yep. Okay. Thanks, Cesar. A question here from Neil about universe selection. You posted it a while ago, but I'll put it up on here. Thanks, Neil. Do you do this with ETFs?
Yes, I do. My longer, my quarterly one is using ETFs. So yes, I do a kind of rotational strategy on ETFs. A very small basket of ETFs.
Okay, excellent. There's quite a few questions here. I'm just trying to pick which ones will. Okay, this is a good one from Richard. Actually, it's about starting to trade rotational and how you implement that. So let me put it up on the screen. Richard, excuse me. If you were to set up a new rotational or trend system with say 10 positions, would you jump straight in and buy all 10 at once, or do you stage it?
That's a great question, Richard. So this is partially a personal preference kind of thing. For myself, when I start a new rotational strategy, usually I will take, let's say it's 10 positions, and I will take 5 of them. I will do it one of two ways. Either take randomly 5 of those and say, okay, I'll use your first 5 this week and the next 5 in a week or two. Or I will take 50% position sizing. And I'll say, okay, I'll enter all 10, but half the normal position sizing, and then wait a week or two, and then buy the other half of those positions. And if new positions come on, I may actually buy them at full position. So hopefully that answers your question there. But I tend to not jump all in all at once, mostly because I don't think it would make much difference at the end of the day. But it would really suck to jump in all 10 and the market decides to sell off right away. It's we're trying to a lot of time avoid our emotional responses, and that's just one way of saying, okay, at least I'm not jumping in all in, and damn, the market's down 5% this week, and now my positions are down right away. Feels a little bit better if you're slowly scaling in and the market's down a lot. So that's how I go about doing that.
Yeah. Okay. Thank you. Here's a question from Scott. We kind of touched a little bit earlier, but let's put this up here. So from Scott, thanks for the question. Is there significant difference in results from different ranking methods Parameter risk is generally generally uncompensated. Do you average several different ranking methodologies? I'm having real problems right now.
Yeah. All right. Let's see. Yes, there is a difference in the different ranking methods. There is a significant difference on them. Do I don't average those. I mean, I have other ways in a sense of trying to making sure I haven't overfit the data. One of them being in sample, out of sample data, another being parameter sensitivity testing. But in general, yes, one method will work much better than another method. It's not. I wish it was simple that there was just one ranking method that worked everywhere and all the time.
Okay. Thank you. Here's a question from Jeff, which is linked to earlier when you were talking about how you've recently switched from mean reversion to breakouts. Jeff would like to know, how do you determine what trading strategy to trade in the current market, or in market environments in general?
Actually, I trade multiple strategies, Jeff. So I maybe wasn't clear that I'm not trading mean reversion. I am trading right now a mean reversion strategy, a rotational strategy, a breakout strategy, another rotational strategy. Like I said, I'm trading at any one time. I'm usually trading 5 different strategies. I'm not consciously saying, okay, we are now in a strong bull market, I'm going to be trading, a trend following strategy. Oh, we're volatility is getting really high. I'm going to now just trade my mean reversion strategy. So I don't try to time the market with my, deciding which strategy it is. I just have a basket of strategies of different types that I trade in order to hopefully, catch. One of them will do well in the market. Hopefully the others will do, 1 or 2 will do well. The others will do okay. One of them may do a little bit poorly, but overall, hopefully my account's doing well. It's the general hope for that. I'm trading multiple strategies.
Yeah. And to that, we've got a question here from Ham or Club Ham. How are your mean reversion strategies performing? Maybe it's just me, but mine are not working as well as they used to.
I've not checked. Like I said, I check quarterly how my strategies are doing. My mean reversion strategy started off the year doing really well, and then the second half of the year, or the second half of the second quarter, I guess, started to perform not as well. So I guess I was seeing a little bit of what you're seeing of my mean reversion strategies not performing as well. But like I said, I don't know. Honestly, do not know how it's doing for the whole year. I just know it started off the first 4 or 5 months doing really well, and then the last month or 2 has been doing less than well. But again, I don't know what the whole. Yeah, I have seen that recently.
Yeah. Okay. Here's a question from Kevin about options. Can this strategy work with options?
I am not an options trader, so I can't answer that. I really want to learn more about options to start trading options, but I don't know. I just haven't gotten around to doing it. Sorry.
I remember we talked about this quite a few years ago, actually, and you were having a challenge with getting clean data. So I don't know if that's still the case now.
Yeah, no, that's still the case. So getting data and getting clean data and being affordable data too. There's just lots of challenges with testing options strategies.
Yeah. Okay. Thank you. Here's another question from Richard. With your portfolio of trading systems, do you care or backtest the portion allocated to each system?
Nope. I keep it simple. I trade 5 strategies. Each one gets 20% of the account. I'm sure I could do better, but it follows the same logic of my, when I'm trading in just a single portfolio of stocks, it's the same amount. I don't know which of the strategies is going to do the best. Well, I know historically which has done the best, but I don't know what's going to do better going forward. So I just equally allocate between them.
Okay. And then a follow-up question from that is from Michael here. Let me put that up. If you get some new cash to invest, do you allocate it to a running strategy? If so, how do you decide which one, or you just wait for a new strategy to invest in?
If I wanted to allocate more capital, I actually would spread it out evenly to all the strategies that I'm currently trading. So, let's say I have a $100,000 account and I got, an additional $20,000 that I wanted to do. So I would take $4,000, from that and add it to each of the strategies. that's what I would do if I, suddenly got, some extra money to be trading into my account.
Yeah. Okay. Here's a question about ranking from Andrew. Let me put this one up. Thanks for the question, Andrew. I have been running different ranking strategies like RAW, I'm not sure what that is, or rate of change, RSI, ADX, etc., to diversify, but hadn't thought of, say, rate of change, but using different timeframes, like you mentioned. Which is safer?
So neither one is, I wouldn't say any of them is safer. It's just a matter of preference and a matter of, testing whether the strategy works better with one, the weekly time frame or the daily. So yeah, I wouldn't say it's safer. It just gives you something different to try. A lot of the things sometimes is trying these different time frames is you don't want to be testing and trading what everybody else is testing and trading. So that's why I sometimes like going up to the weekly or doing something just a little bit different. It's just because I'm trying to avoid what everybody else is doing potentially.
Okay. All right. Thanks for that. Oh, Andrew just clarified that RAW is rate of annual return. So,
Okay.
There we go. So, question from Club Ham, another one. Do you trade the same security with more than one strategy?
No. So I purposely try to avoid that situation by having my universes not overlap, and maybe once a year will I have a symbol show up in two different strategies, and that time I will trade it in both. But I will keep a little bit extra eye on it in the sense of because then I'm kind of getting a little bit more exposure to a single stock that I might want. So depending on the stock, but I usually avoid that situation by the universes selected for each of my strategies.
Yep. Okay, thank you. There's a question earlier about your research approach, which I thought was quite interesting. Here we go, from Jules. Let me put this one up. Excuse me. Do you prefer to backtest strategies or create custom indicators and backtest them to see if they are interpretable?
I prefer to backtest strategies. At the end of the day, all the indicators are working on the same thing, which is just price, just the closing price, or maybe high, low, and open volume. But there's only so many different ways you can slice it. And I know we all look for the newest indicator that does better. Heck, I just did a post on the whole new indicator. And I'm just like everybody else. If I see a new indicator I haven't seen before, I will likely test it. But I'm not purposely looking for a new indicator. I'm just I've got my set of indicators. I know generally what I want to do. It's like, okay, at the end of the day, I like to keep things simple. So I like the simple indicators. I don't, my breakout strategies are very simple. They're looking for, there's a new weekly high or a new, you're using weekly bars. There's a new high. It's not doing anything that fancy. I find that they still work for me. I just have to combine them in unique ways, in a little bit different ways. But that's just my preference. Some people like, trying to find the new indicator or something like that.
Yeah. I recommend, I think that question was from Jules, to go to Cesar's website, alvarezquanttrading.com. Publishes a lot of research there, and you can learn a lot about how Cesar looks at the markets. I think you published some great stuff on there, Cesar. So thanks for sharing all that. Here's another question from Jules, actually. Let me pop this one up on the screen. Do you believe day trading strategies can be low effort also?
I have not tested or day traded in probably 15 years. I cannot imagine day trading being anywhere near low effort, unless you've somehow figured out how to fully automate it, I guess. But even then, I'd argue you still have to watch it during the day because you just never know when things are going to break. No, not. I think day trading that's a lot of work.
Yeah. Okay. Here's a question from Simba. Do you set a hard minimum amount so it's not all just comparative to other stocks?
I often will do, yes, a hard, I will either a momentum or like a trend filter. So, I'll say something like, hey, it's at least got to be up got to have positive return over the last 6 months, or say something like it's got to be above the 100-day moving average or something like that. Yes. So I usually will have some sort of it's got to be moving up kind of filter for it. Because there are times where things just start to crater and nothing looks good, and I'm not looking to get into the one that's gone down the least. I'm looking to get into one that's gone up the most, kind of thing.
Yeah.
So.
Okay. All right. And the question here from Michael about how you actually execute your positions. Let me put this one up. When you need to enter a new monthly position, do you have a strategy to execute the entry, or do you just use a market on open type of order?
I will do one of three things. Part of it, a lot of it's dependent on the stock. So if I am, let's say, going to be entering, my NASDAQ 100 rotational strategy, unfortunately, I'm not trading so much that I'm going to be able to move Apple or Tesla. So I'll do a market on open, and you know what? I know I'm not moving the price at all. The stock, my strategy where I am, trading stocks that I've really only been trading 2 to 3 years. So I trade Interactive Brokers, and I will either use their TWAP order or their adaptive, what is it called? Their adaptive entry. They have an adaptive order too. So I'll use those two orders in order to avoid just getting in all at the open, because I find these stocks tend to be a lot less liquid at the open. And if I throw in, even a small amount at the open, I can move that opening price quite a bit. So that's what I do, is using Interactive's TWAP and adaptive orders.
Okay. Here's an interesting question from Good Old Boy. I'm going to put it up on the screen now. Why should an algo systems developer build his own portfolio of systems rather than just invest in the S&P 500 index month to month? I'm not understanding the advantage of algo trading.
There's nothing wrong in investing in the S&P 500 index month to month. I mean, the reason we're trading is we believe that we can get better returns, less risk than trading, just the S&P 500 index. That's the goal of the traders, is one or the other. For me personally, I'm now at the point in life where I'm just, I'm looking to beat the index yearly by, only 25% or so, but with a lot less volatility. I've gotten it to the point where, I'm not looking to, double my money or anything like that really quickly, but more keep my money. And, that is the advantage of an algo trader, is, you can potentially do that. Now, of course, you can really screw things up as an algo trader and lose a lot faster. And, maybe you should have been invested in the S&P 500 index. I do have algos that work on the spiders that I trade using on the spiders. And it's very much, I'm just sitting in the index, sometimes I help. Right now I am part of my one of my algos.
Yeah. Okay. And then there's a comment in the chat here as well about the drawdown of the index, and it's had a recent. I'm just trying to find it here. If you look back over 100 years, it hasn't always performed the way it has now, and S&P has had very big drawdowns. Algo trading tends to have less, which is a good point from Scott. So thanks for sharing that one, Scott. Now I'm just scrolling through the chat, and I think I've got all the main ones. One more from Kevin, and then I think we'll start wrapping up. Do you trade? Oh, let me put it on the screen first. Do you trade any futures?
No, I don't trade any futures. No options, no futures, no currencies. No desire to. It's yeah.
Yep.
Sorry.
That's fair enough. I got a comment here from Faith saying that your blog is fantastic. So,
thank you so much. It's always good to hear that people are getting something out of it. Like I said, I try to write something every month that's good for beginner, intermediate traders to learn about the markets. And I've spent a long time making lots and lots of mistakes. I'm trying to help prevent others from making those same mistakes I've made. And and there's lots of good ideas. If you're looking for a strategy you can start trading straight out, you're not going to find that on my blog, but you'll find strategies to get you started and start making you think about, oh, this looks like good, maybe I can modify this to make it work. So that's a lot of what I'm trying to do.
Okay, well that leads nicely into my final question about how can people actually do that, and how can they get in touch with you or discover more from you?
Right. At my blog, I've got there's a contact me form there, or you can send me an email at Cesar@Alvarez Quant Trading. Either one of those things. I love talking to traders and answering questions. And on my site, like I said, I've got lots of great information on various topics there. If you're looking for strategies to give you an idea of where to get started on mean reversion, rotational. I've got some rotational ones in there. So yeah, definitely go take a look at the blog. Lots of great information there.
Yep.
Like I said, I've been publishing for 8 years, so lots of great stuff there.
And don't forget all the books that you've contributed to as well.
Oh yes,
over the years.
Yes.
So there's a wealth of information from Cesar.
About 4 or 5 books there. I see up on my shelf.
Yeah, I've got them all up here as well, up on my bookshelf.
I can see the black ones there. Yep.
Yeah. So I was going to wrap up, but there's been 2 questions come in very similar from 2 different people. So we'll make this the final question, and then we'll finish up. It's about dual momentum. I'll put Simba's question up, but
yes.
Bill also asked a very similar question. Do you look at dual momentum at all? For example, the strength of stocks versus an industry or index?
Well, that's okay. That's not what I call what it would say is the classical definition of dual momentum. But yes, I do a modified dual momentum strategy. Yes, with ETFs, with like the spiders, and I don't even know what the ETFs are. Probably the spiders, a international one, TLT, junk bonds, stuff like that. So dual momentum is kind of I do like the dual momentum concept, but I've added my own small tweaks to it. Again, mostly to make it my own. I don't think it's like I've made it that much better, but I find if I put my own tweaks on it, I'm more likely to keep following the strategy.
Yeah.
So conceptually, I really like the dual momentum idea.
Yeah. All right. Well, thank you very much for your time today, Cesar. It's been great chatting to you, and we had a lot of good questions in the chat today. So thank you for everyone for contributing as well. And again, thanks again for such late notice and joining us. I really do appreciate that. You got me out of a bind. So thank you very much. And I recommend everyone go and check out Cesar's blog, alvarezquanttrading.com. Lots of great info there. And please give us a thumbs up and subscribe to the channel. And you can receive more notifications when we have lots of good content coming. So just in the chat, we've got a couple of comments. We've got a thank you from Andrew. Ola. Ola's always good to contribute. Always, as always, heaps of valuable ideas. Great session. Thanks to Cesar and Andrew. So yeah, thanks a lot.
Thank you all. Thank you all. Thank you, Andrew. It's an honor always being here talking to everybody. And I just, like I said, if I didn't answer your question properly or you didn't get your question answered, definitely use my contact form, get out to me, and I will answer those within a day or 2.
Yeah, absolutely. All right. Well, thank you very much, everyone. See you next week. I won't see you next week, Cesar, but thanks again for joining us, and take care.